Stock, bonds groggy after rout, eyes peeled on Fed. New York global shares and bonds gyrated in choppy trade on Tuesday after the prior day's marketplace rout, even as buyers braced for a U.S. interest charge rise this week that could be the most important in 28 years. Surprisingly sturdy U.S. inflation information released ultimate Friday has fueled bets that the Federal Reserve need to tighten monetary policy greater aggressively to tame soaring expenses. Fears that the tightening ought to bring on a recession walloped worldwide equities and authorities' bonds on Monday. Investors are actually having a bet with close to truth that the Fed will announce a 75 basis point charge boom, the biggest given that November 1994 at the give-up of its two-day coverage meeting on Wednesday. It's the meeting each person has on their radar. And the marketplace may be putting off each word Fed Chair Jerome Powell has to say, said Chris Weston, head of research at Pepperstone Group Limited, a currency dealer in Australia. The market wishes answers on its commitment to ruin inflation. MSCI's gauge of stocks round the arena dropped 0.25% to levels remaining seen in November 2020, even as a pan-European equity index slumped 1.26% to March 2020 lows. Underscoring expectations of rising U.S. fees, two-year Treasury yields rose as high as 3.430%, the best level when you consider that November 2007, while 10-year Treasury yields struck an 11-year excessive of 3.4620%. U.S. markets now see the Fed's rate hike cycle peaking round 4%, as opposed to the 3% visible remaining month. Euro sector government bond yields also hit multi-year highs, as spreads between core and periphery widened amid worries about expanded significant bank financial tightening. GVD, Euro investors' repricing of higher quotes has pummeled belongings that benefited from rock-bottom hobby fees, along with stocks, crypto, junk-rated bonds and emerging markets. Monday's sell-off driven the S&P 500 index right into a undergo market, with the index falling more than 20% from its January 3 document last high. Graphic. Fed terminal rate 20 image percent 201,655,115,726,737.png. Quite absolutely. When we see financial tightening the order of what we're seeing globally, something is going to interrupt, stated Timothy Graff, head of EMEA Macro Method at State Street, NYSE, STT. Stock markets are reflecting the reality of the first-order impact of tighter economic conditions, Graff stated, predicting that with U.S. inventory valuations nevertheless above COVID-era lows, there may be extra pain to come back. I suppose there are different shoes to drop, he stated. MSCI's broadest index of Asia-Pacific stocks outdoor Japan closed 0.59% decrease, tracking Wall Street's losses, even as Japan's Nikkei lost 1.32%. Crypto markets, in which Bitcoin and Ether hovered near 18-month lows, have also been drubbed via hobby rate expectations and crypto lender Celsius Network's selection to freeze withdrawals. Bitcoin, which fell as little as $20,816, recovered to $22,599 on Tuesday. Brent crude futures rose 0.2% to $122.05 a barrel, supported by using expectancies that supply will stay tight. State Street's Graff did no longer see recession as inevitable, however said that financial tightening and the squeeze on actual earning from commodity fees suggest the chance has gone up. Rising yields and the flight from risk helped the dollar surge to a 20-year excessive against a basket of currencies. The dollar index, which measures the dollar towards a basket of 6 foremost currencies, become up 0.2% after hitting an excessive of 105.46. A sturdy dollar pinned the euro close to a one-month low at $1.04225, and pressured the yen, which languished near a 24-year low at 134.94 against the greenback. USD with the Bank of Japan increasing bond purchases on Tuesday and unlikely to budge from its ultra-low rates coverage at its Friday assembly. A respite for the yen looks not likely. Given Wednesday may additionally see the Fed go 75 bits per second and flag extra, while the BOJ on Friday will handiest flag greater bond buying, the yen isn't going to live at those stages for long. It's going to get plenty, a lot worse, Rabobank strategist Michael Every stated. A strong dollar and growing yields weighed on gold. Spot gold slipped 0.4% to 1,811.40 an Oz. GOL. Graphic. King $20. JPG.